Hey, good afternoon, everybody. Marty Missouri here. It is Friday, the 20th of October, 2023. Second time at you today with a video commentary. This is your weekly economic update, and I'm going to just jump right in and not keep you too long. In front of you is the PWA index. We actually rose 2 points this last week to negative 19.15. Still recession signal flashing. So I did hit on retail sales in the midweek market snapshot, which actually came in, at least on the surface, surprisingly strong. And I also touched on the housing index, or the home builder sentiment index, which is what we refer to it as being really down. So some optimism from the hard data of retail sales, perhaps. Again, as I discussed, there's, may not, under the surface, it may not be as robust as it seems. And soft data, which is sentiment among home builders and among consumers, as I reported to you last week, really is suggesting that there is some real potential weakness to come. Speaking of housing, I guess it should come as no surprise based on the height of mortgage rates these days that mortgage applications for purchases continues to plummet to mid-90s lows, which is pretty amazing, but makes sense when people have locked in long-term 3% mortgages. Things are going to slow big time. So staying with housing, we got starts and permits data for September out this week. So as you can see, they came in at 1.3 million, up a little bit from the prior month, but that was 25,000 less than the consensus expectations, and the August number was actually revised down by 14,000. Single family starts rose by 30,000 up to 963 after falling by 55,000 in August. Multifamily starts, I don't have a chart for that, rebounded by 59,000 to 395 after a large 138,000 count fall in August. And by the way, I'm reading from economist Peter Bookvar's notes. With regard to permits, overall we're down to 1,473,000. With regard to single family, they actually continued to rise up to 965,000, which is the most since May of 2022. Multifamily, we're down by 85,000. Initial jobless claims really continue to fall. This surprises me, quite frankly, down to below 200,000. Now, there's continuing claims that actually did go up week over week, and they are staying at a relatively elevated level right here. That suggests that, while people aren't necessarily losing their jobs to any great degree, but people aren't coming off of unemployment either, or finding new jobs necessarily to any great degree of late either. So again, there's a lot left to play out in the labor market as we go forward. Among equity sectors and their signals in terms of how they are correlating with one another, among others, we track consumer staples, XLP, against consumer discretionary, XLY, staples, things you got to buy if you want to stay alive, discretionary, things you spend your extra money on. Discretionary relative to staples this year have outperformed measurably. However, there was some consolidation here. We broke out below that, and we really spiked up here recently. The perceived message as these things trend is that when staples are outperforming discretionary, that's a sign that investors are becoming more conservative and buying those more inflation-resistant stocks, as opposed to the ones that ultimately get creamed when people stop spending. Last but not least, I wanted to just kind of share with you the dynamics around the yield curve currently, which are quite interesting. So the yield curve is kind of everybody's recession indicator, okay? And typically it's upward sloping. And what I mean by that is short-term interest rates are generally lower than long-term interest rates. So as you go from the very short-term, 3 months, 6 month, 1 year, 2 year, 3 year, 5 year, you get this upward sloping curve when you track those interest rates on a graph, right? Well, an inverted yield curve is when the short-term rates are actually higher than the long-term rates, and so the curve goes down. So you have the curve going in the other direction. So what this white line here tracks is the spread between the 2 and the 10-year, probably the one most watched. So when it's rising or when it's above 0, the curve is positively sloped like it is most of the time. When it's inverted, it's a recession signal. Since like 1950, 100% of the time, recessions follow inversions anywhere from like 7 months to a couple of years. So it's not a great timing tool, but it's like, uh-oh, it's inverted. Therefore, recession is coming at some point in the future, right? Here's what's interesting though, is that typically the recession doesn't occur while the yield curve is inverting or while it's moving lower. It's when it begins to re-steepen, so to speak. That's when we're getting really close to recession. So you can see what I mean by that. So here it is, a little inversion there and ultimately inverted pretty steeply. And then it re-steepened or it uninverted, boom, recession. Uninverted, boom, recession. Uninverted, boom, recession. It's just a slight inversion before COVID. So you can see that. And then the 3-month 10-year spread, supposedly the one the Fed watches, there's the, the steepening, recession, steepening, recession, and so forth. Well, look at this steepening. It's quite dramatic. Now, here's what's unique about the current character of this steepening yield curve. We're still inverted, but we're getting close to being uninverted, right? And it totally comports with our recession thesis going forward, right? So, yeah, here's evidence, here's history, gonna happen, right? Well, typically, not always, but the lion's share of the time, what you're looking for is what we call a bull steepener leading to recession, as opposed to a bear steepener. So what's a bull steepener? What's a bear steepener? So a bull steepener is essentially folks actually buying bonds. Now, they're anticipating that the economy is going to shrink or contract and that the Fed is going to be cutting interest rates soon. Therefore, the 2-year, which is everybody's indicator for Fed funds rate, people buy that up. They get a nice big 2-year yield, but they're buying it because they expect to get some appreciation out of it as the Fed cuts interest rates. And they're buying the 2-year, pushing the price up and the yield down more aggressively than they're buying, say, the 10-year, right? But they're buying both tenors. It's just that the action is forcing the 2-year yield down faster than the buying of the 10 is forcing its yield down. We're actually getting right now what's called a bear steepener. Now, typically people sell bonds when they expect inflation to pick up, the economy to pick up, and therefore interest rates to pick up, right? People are selling the long end and selling the short end. But in this case, right now, they're selling the long end more aggressively. So essentially, the Fed is implying that they're probably done hiking interest rates, but they're probably going to leave them higher for longer. But right now, if you're looking just for an economic excuse as why yields would go higher, it's because the market might be suggesting that the Fed isn't going to do enough. So we better sell that longer end of the curve. Early 80s, you did get that kind of steepener before a recession, but it's just not typically what you look for. Now, ultimately, what does a bear steepener do? It forces lending rates higher. It's not typically what you see. It's not typically what you get when you're looking for that recession signal. But nevertheless, it is a really bad omen of what it ultimately portends for the economy. Tighter financial conditions ultimately leading to an economic contraction. So my view, or our view, is that, yeah, we get it. It's a bear steepener, but it just puts that much more weight on the economy. What suggests is that the market just isn't seeing the recession as being imminent like it does when you get the bull steepener right before recession. So probably going to get the same thing out of it. At least that's our assessment. Question is just the timing. Is it going to hit us very, very soon like some economists expect? Or is it going to be second half of next year like others expect? Oh, and then folks, here's what I wanted to close on. I copied some commentary on Fifth Third Bank's earnings call. With respect to the economy, while aggregate figures on spending and employment remain strong, and market sentiment has shifted more in favor of a soft landing, we continue to be more cautious given concerning signals disguised beneath the aggregates. For example, while the most recent headline payroll numbers were strong, most, if not all, the job growth is a byproduct of more people working part-time jobs. Real average weekly earnings swung every month during the quarter, and the lower end of the consumer spectrum now maintains deposit balances below pre-COVID levels. Anecdotally, the last time Google searches for soft landing were this high was in May of 2008. I'm not going to propose that we have a great financial crisis in front of us. We're just going to propose that the risk remains that recession could be right around the corner, and asset prices will very likely follow the economy lower. Therefore, with our core portfolio, we're going to continue to hold defensive positions and continue to hedge with options. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Be back next week. Take care. Bye-bye.